We have curriculum, practice, and research. And talk a little about the curriculum pillar during Roland's talk. Now what we'll do is we're going to just kind of bring in the whole concept of the practice pillar in line of Ron's talk. Practice is really anything with industry, kind of how we bring industry techniques and best practices kind of into the center, and also to provide a vehicle for firms to be able to hire people, from Villanova and engage people from Villanova to practice and analytics. So kind of did that a couple of ways with Ron. Ron is a member of the advisory council and really appreciate Bank of America's support by virtue of Ron being an advisory council. At the recent advisory council meeting, we meet up 2 or 3 times a year, but at a recent advisory council meeting, we had a couple of students come and speak to the advisory council. We had an undergraduate student and a graduate student. And by virtue of them coming, the graduate student was Tim Barstock, who's in our audience today. By virtue of Tim coming and speaking about his analytic experiences at Villanova, it ended up, Ron and him had a conversation at the end of that period, at the end of that session, and it ended up with a job offer for Tim. So Tim is going to join Bank of America next month. We really appreciate that. And that's just the way that the center kind of works in connecting students with industry. And also, I just want to mention that inside of the Center for Business Analytics, we set up an arrangement with Lehigh University, specifically the Lehigh University Enterprise Systems Center. They're really big in industrial engineering. The Enterprise Systems Center is attached to the School of Industrial Engineering. And they've had an active consulting practice for about the last 10 years. And the way that their consulting practice works is that it's led by experienced people, either professors who are usually business professionals who kind of go out and manage the projects and direct the work, a lot of the work, and mentor people who do the guts of the work, which are students. Okay, so students either in undergraduate or graduate work. They've been doing it about 10 years. They approached us to look at PICO's customer service center, specifically how we can improve the forecasting of the customer service center. And again, that came through a relationship with the advisory council. Mark Hall, on the advisory council, and work for PICO here. We appreciate Mark's efforts in doing that. So you people from consulting firms are in the audience. Beware, because the Villanova Lehigh consortium is going to come out and take some business from you guys over the next couple of years. I'd like to introduce Ron now. Ron Cline, as I mentioned, he's a member of the advisory council. He works for Bank of America. He went to Dickinson College, majored in policy studies, and has an interesting story of how he got involved in analytics. But Ron's going to talk to us about how you optimize data, specifically inside of a customer acquisition, and inside of a customer acquisition, specifically in credit cards. So please join me in welcoming Ron Cline.
Thanks, Tom. I'm going to go without the mic. I usually don't have a problem being too loud. I have 2 children. I coach both their sports teams. Softball and little baseball just ended about a week ago, so I was a little hoarse prior to this week, but I got a little time back on my hands, which is great. But anyway, before I get into the presentation here, I'm just going to talk a little bit about my background and how I really kind of stumbled upon analytics. I started at the bank in 1999 in a entry-level position, talking to customers, worked as a credit analyst, then did some training, had a little management position, and then in 2001 I got an opportunity to get my first analyst job. And when I got that job, it was really when predictive modeling, which was something that was foreign to a lot of people, it was something that, like a FICO score that you bought from a big company, was starting to really pump up internally. We were looking at all of our data, and we had this very disparate data warehouses, and we were able to bring it together and start to build customer level risk scores, which were things that was very foreign to the management team. So when I heard Roland speaking about how do you start to connect the dots with analytics and really centralizing strategy, I kind of lived through it for the past 13 years of my career, and to be honest, I've seen incredible progress. Technology, as Roland mentioned, really is the centerpiece for being able to do the data mining and the analytics. And then a big piece of it is being able to explain future expectations. So when I see analytic projects fail, it's typically because there wasn't enough socialization prior to testing or development that really is able to predict the outcome of what you're going to expect. So managing those expectations is crucial to any success in implementing any type of strategy analytically related. And the optimization experience that I'm going to go through is one that really forced me to understand that more than I ever have in the past. I started as a risk analyst, so it was pretty simple. Find people who don't pay their bills. Mine data, credit scores, revolving debt, whatever it may be. And the goal was simple: don't let people charge off. But when you think about what we're doing on the marketing side, you're contemplating a lot more metrics. You have to be, and I'm going to just jump right in and kind of get to the background. So the background started in about 2008. Like I said, I grew up on the risk management side of the house. And in about 2006, I went over to the dark side of marketing, as I like to call it. Where everyone's just spending money, marketing, creative looks good, but to be honest with you, that's where I met some of the most analytical people I've ever encountered. We had a database marketing group that did a lot of predictive modeling on response. So they were predicting, who's going to respond to our marketing pieces. And so growing up on the risk side, I have this risk modeling background. Now I meet all these database marketing guys, all these PhDs in stats, they're writing their code in Unix and building these predictive models. And I'm thinking, I know this risk thing, they know this marketing thing. How do we start to bring it together? And luckily, well, I shouldn't say luckily, 2008 was a pretty bad time period in the credit card industry, given the economic environment. So I was running our marketing strategies, and we were pulling back a lot of marketing dollars. We were, getting very conservative, not spending money, a lot of scrutiny from our finance partners on return on investment, and really our marketable universe was contracting very dramatically. And the reason it was contracting dramatically is because we had a very siloed approach from each business partner. So our finance partner would look at return on investment. Our risk partner, which I used to be, would look at risk. Our marketing partner will look at response. Our planning and forecasting and marketing budget guys will look at marketing investment. So we had all these competing objectives. And our old methodology was just to kind of use some models, cut out the bads, and whatever you're left with, that's what you would market. And that worked for a long period of time until we hit this economic period that we just weren't ready for. So as that environment was contracting, I was given the opportunity to create a little small team to really think about the business in a different way. And I have a gentleman that works for me who's PhD in mathematics, and we've done some dabbling in optimization over the years, and it was finally a time when we could actually apply it in a real market, in-market test. So we started building out this optimization framework. And really what optimization gives you is the ability to balance multiple business objectives. And that's the piece that was missing from our process. In our case, it's credit risk, account production, marketing expense, and minimizing or maximizing a certain objective function. Our objective function, of course, we're a publicly traded company, we're a bank, NIBT, net income before taxes. That's our goal, which recently has evolved to something a little more sophisticated, but at the time that was our specific goal. And basically what optimization, like I said, gives you is just this flexibility, this nimbleness, and this preciseness to your marketing strategy. Some of you have probably seen this chart here. I stole this from SAS. Actually, they let me steal it. But it's also a similar version is in the Davenport books. And basically, when I look at this chart, I couldn't agree anymore. You kind of start with standard reporting, ad hoc, query drill down alerts. Then you get into your statistical analysis, forecasting, predictive modeling, and ultimately optimization. So our big inputs into our optimization process are predictive models, our forecasts, our financial assumptions, and then of course through constraint measurement we also bring in a little what I'll call art, a little bit of art to the process where we certain things based on known risk in the market, known risk relative to our competitors' position, things of that nature. So this is just a graphical depiction of optimization. Like I said, we had this old silo, rules-based approach where, you know, if you didn't meet all three, and there was actually more than three, this is just graphically illustrated, but if you didn't meet all three pieces of the criteria, you were out. And when we started this optimization approach, we started showing our business partners, and this gets back to the managing expectations. You know, if I were to go to my risk partner and say, hey, I want to target these people over in this region, they would say, no way, you know, they're way too high risk. But when I tell them that I'm going to balance them, you know, with these people in this low response region, and they're very low risk, I end up coming out with this blend that's very comfortable. And that's essentially what optimization is. It's being able to identify, you know, really taking all of your inputs and being able to mathematically compute your margins, you know, through a very scientific approach. And it was foreign to my business partners when we started to implement this process. And it took a good, I'll say, 12 to 18 months to get people comfortable with what we were doing. We did it took us 9 months to kind of get people to agree to an in-market test. It took another 9 months to get people to agree that it's better than what we were doing historically. So really an 18-month time horizon. So to me, that felt like geologic time, but the reality was we were making incredible progress. And I sit back on meetings now, and I hear people talking about things like, you know, this risk constraint is a little too high or a little too low. And, you know, 2.5 years ago, or 3 years ago, whenever we were really kind of rolling this thing out, when I explained what a constraint was, people would mistake it with an exclusion. You know, oh, we need to constrain this. Well, cutting everyone out isn't really a constraint. You know, it's an exclusion. And I had to correct people. And you know, it really was an interesting process, not only academically, professionally, but also sociologically. You know, kind of watch people evolve over time and really start to embrace the optimization and the work that we were doing. So this is just a very simple case study. So this is actually about 9 months after we started, when I was going back trying to get everyone to buy in officially and kind of do away with their old BAU process, BAU, business as usual, for those of you that aren't used to those terms. But here's just a couple key metrics. These are some of the dimensions or the decision spaces that we are constantly discussing. So in this very simple scenario, you can see that, like Tom said, it's a direct marketing program that we were doing. But you can see that, and these numbers are illustrative. But you can see that these numbers, you know, we're basically, with our optimization approach, we're reducing our mail volume. So we're targeting less customers. We're getting a slightly lower response rate. We're getting a much smaller number of counts, which that in itself, still to this day, is a huge argument. For those of you that work in companies who are sales oriented, it's hard to tell a salesperson you're going to get less units, but it's going to deliver much more value. That's a hard conversation, and I have people still to this day that I have to go and explain and validate and convince and plead and twist arms and whatever you need to do to at least get them comfortable with what we're all about. But the big one here is the projected risk, and coming out of that economic cycle, that was really my risk management folks were really the ones who were endorsing me, and they were helping kind of push this stuff through. But you can see that we're able to spend roughly the same amount of money, yield a smaller number of accounts, but significantly reduce our risk. And 85 basis points may not seem like a large number, but in terms of dollars, that would equate to roughly, a bit in a new marketing campaign is roughly about $400,000 in losses. So you can see that $400,000 times 85, pretty big number from a risk perspective and on the loss mitigation side. Projected profit, you can see that we increased that by 22%. And that's ultimately our goal, maximizing profitability. And of course, the marketing investments the same as our mail volume, essentially a 2% reduction. So what do we end up doing? We end up finding $34 million in projected profit over 4-year campaigns. A lot of it driven by the reduction of risk. We've reduced risk by 85 bips. We also reduced our marketing investment by $1.5 million. And really, this was the page that just said, look, why would you not do this? Why would you not? Why would you not take a leap of faith and use a little more math and science in your approach? And obviously, I'm still around and I'm hiring people, so it must be working. The next slide here is really a slide of scenarios. So one of the great things about optimization is scenario simulation. And this slide actually went over very well at our credit risk committee when I was presenting this a few years back. I gave each executive their own scenario. So I painted a scenario for my marketing partner. I painted a scenario for my risk partner. I painted a scenario for my my product owner, who is very unit oriented. And I kind of walked through these different scenarios, and there's a bunch of execs sitting around the table talking about this, and to hear their dialogue around which scenario they wanted to take was amazing. So it created a good, healthy debate around what our strategy should be. And historically, we've never had that debate. Historically, we sign up for our plan, work with our finance partners, set our plan. How are we measuring against that plan, positive or negative? And there was no real, and everything was reactionary. We're below our plan, we're above our plan. Well, let's move this, let's move this. This gives us this flexibility of saying, where do we want to be? Here's our forecast, here's our scenario. Let's run a simulation, and let's talk about the trade-offs. And you have a lot of people who want to do this, unconstrained optimization, but that's not the reality of the business world. If we had perfect information, that could be the case. But every model that we use has a certain degree of error. Every financial input has a certain degree of error. So to really kind of hedge it, you want to build in these constraints. And this, again, is just kind of a sample of a menu of options that an optimization discipline delivers. And like I said, it's really interesting because it creates this good, healthy debate. And something that we're going through on the banking side today, if there's any other fellow bankers in the room, there's a lot of new regulatory guidance from the Fed and the OCC around model risk management. So the last guidance came out probably about 10 years ago. And this guidance really focuses on the decision management component in model risk management. So historically, it's all around methodology, validation. Did you kind of do your academic checklist to make sure that you're not violating any principles? Now it's more about what is the control you have around decision making. And one of the big requirements is, in installing a process where you have good, healthy debate about practice and decision making. So, of course, optimization kind of fits right into that category. So I've been working a lot with our internal policy folks to kind of build out our framework to comply with this new guidance from the regulators. But again, optimization just gives you a ton of options, flexibility, and precision in what you're trying to manage and achieve. Next slide just kind of goes through a couple of big points for us. When we started October '09, very simple. It was we had just one offer we were trying to optimize, build some proprietary algorithms. We found the 30%, and this was really when we had this shrinking universe. So we found this 30% incremental volume at the same risk. Second phase is we started getting to a little more offer dynamics. So we have this predictive model, predict sensitivity across different offers we want to present to people. How do we match those with the right people? So the first rollout of that model suite or offer suite, I'll call it, looked at very simply. So we looked at every customer, and they had, I'm just going to say we had 10 offers, really it was 72, but we'll blow it down to 10. 72 is too many options. So they had 10 offers, and of these 10 offers, when we first rolled this out, we just said, there's one measure, NAT or ROI, let's define. We're going to pick that offer that's the highest ROI for that individual. And that seemed like a very logical good strategy at the time when we rolled it out. When we started building out this optimization framework, we realized very quickly that it's not always the best offer for the individual that we necessarily want to extend to that person. You might want to give a person where an offer that's going to give you 2 bips less in ROI because it's 10 bips less in risk. And you'll pick up that ROI margin on someone else where you can solve for that risk constraint. So when you have these real constraints that you need to manage to, it was another one of those learning educational moments that honestly I didn't even really expect to see until we started analyzing the data. Where I had to go present to a finance partner and say, or a marketing partner saying, yeah, we're not giving that customer the best ROI offer individually because there's a greater good that they're solving for. So there's a more disciplined approach and there's better math if we have different combinations. So that was a very interesting part of our rollout and our progression over time. And here's some stats on some of the numbers. 14% lift in profit, big lift in volume, and then a big lift in our account production. And then a couple more we brought in. Here's where we started to break down some silos. So we used to have these certain programs from certain segments literally were executed in physically different locations by different teams. So same objectives, and historically, maximize ROI, profit, minimize risk, have a certain response effectiveness, but they didn't communicate to one another. So when we added up the results, they didn't really meet all of those parameters that we were trying to really solve for. So our next phase was really to integrate these separate processes and kind of have one big optimization process. And that, again, a lot of education, a lot of hand-holding to make sure that you're not, the big thing I learned through all this is when you're trying to deploy these optimization strategies, you have to make sure that the people who own these processes, that they're not feeling like they're not the owner anymore. So ensuring that the ownership doesn't change and the decision-making doesn't change, but synchronizing it and integrating it and explaining why it's a better end result, that takes a lot of tact, I'll say. And then the last one is kind of bringing the multi-offer component and the silos all together. So it's interesting because when I originally did this slide some time ago, and I had some big aspirations, and little did I know that there were some other groups in Bank of America, the giant company, 300,000 people, but there were other members in different areas of the organization doing very similar work. And we had some guys on our marketing side, on another side, on our retail banking side, marketing, doing some optimization. We had some guys in our insurance group doing some optimization. We had some guys in our mortgage group doing some optimization. So little did I know that all these things were happening, and over time, as you start to present these things at a senior level, you start to make some connect points. And we've actually recently, which is why Tim's going to join our group, started to centralize our optimization work. So we're bringing all of our lines of business, and the bank as a whole is going through that transformational process where we're really collapsing the historical line of business silos, taking a very customer-centric approach, centralized approach to managing our strategy, our modeling, and ultimately our optimization. So when I put this slide together, there were actually some people doing some of this e-com stuff, and I found out about later. But I'm working with them currently, and there's a lot of opportunity. And I know the next presentation is going to talk about digital, mobile analytics, and I'm very interested to hear about that because I'm currently involved in some work on the digital side. But ultimately, what we're trying to do is build this framework where we're making decisions consistently across our products and our customer base. I don't think I have anything else presentation-wise, and I'm more than happy to ask some questions, answer some questions.
Mike, we talk about the profile customers and trying to optimizing that mix. Do you also get into like the vehicle mix in terms of what types of promotional activities get the best response rate? Or is that
Meaning channel?
Like channels. So I do it email, so I do it direct.
So that's so what's interesting. this first point here, we've spent a lot of time building out our enterprise contact history database. And I'll give you some alarming numbers. 11 billion promotions when we start, and that's not even all of them because we don't have all the major activities we have consolidated. 11 billion promotions in a year. It's a huge number. It's the data. Seriously, when people say big data, I'm like, I know what big data is. It's big. It takes a query like 2 days to run, but we chunk it up, we optimize it. There's also optimization, obviously, on the tech side. But that's one of the things that we're really starting to test out, and it's this chicken or the egg dance, because you can very easily have a very coordinated contact strategy around the product. So I want to get this card offer in. Thank you, Sarah. Then I want to follow it up with a mail piece, and I want to follow it up with an email, and then when I go onto my website, I want to pop it up in front of them. And that's very easy to do for a single product. But when you have, let's call it, maybe 6 major types of products, but underneath that, some variation, maybe to 50, now it just becomes challenging to kind of manage all that data. So we're working actively on organizing a lot of that data and putting it into hierarchies so that we can have a more deliberate contact policy throughout the channels. In regard to the offers themselves, meaning the pricing, for example, we have a lot of predictive models that pick up the elasticity of consumers related to pricing. Any other questions? Go ahead.
You're saying that average program is an organization
Yep.
what is the team to do that? The systems are using teams homegrown versus
So the marketing problem is big, but some of the other problems that we saw that would have optimization routines around, the number of variables is much smaller. But in regards to systems, we basically have 3 major systems that we're working within, meaning data warehouse systems, collective tables, databases. But ultimately, once we start crunching the numbers, it all comes down to one place. So there's a problem helping with our banking center folks. The number of decision variables, maximum number of decision variables that would be in our decision matrix is about 11.5 billion. When you take 70 million customers, 50 million offers, 5 channels, 5 sub-channels. So it's a huge decision matrix. So the computational power that you need is extraordinary. And there's a lot of things out there that people are selling. I get a lot of sales calls, given the size of the data that we're managing. And to be honest with you, the better approach is to really try to minimize the problem. So how do we minimize the problem and not require 200 gig of memory to solve it? We can solve it with 1 gig of memory if we really think about the problem and kind of minimize the dimensions. So those are how we solve some of those problems, but the data itself is big in the true sense of the physical term.
Are you using SaaS? Are you using server?
All of the above. There's a bunch of products that are out there. The SaaS is a big player in the analytical space, which I'm sure most of you are aware of. IBM.
How long?
I personally, I'm not using that, but I'm sure someone in the bank is. We have a lot of different softwares that we use. Yep.
Is that a global 11 million? Or there's only 300 million in the United States?
Right, exactly. And like how many of them are federal for like 50? Right, so we're right. Small, but that's not just credit, that's all promotions.
Okay.
So that would be something as simple as, log on, enroll in online banking.
Okay.
So it includes all of our digital impressions.
And that's annual or the history?
That's like a rolling 12 month. So it includes like a lot of it is digital impressions. Digital impressions, I heard someone mention it earlier during Roland's presentation. How do you start to mine that data? That's a good question. And someone mentioned something about sentiment and how do you account for sentiment in whatever your company is or whatever your activities are. And I had a lot of thoughts one thing I think that is very effective is you figure out a business metric that correlates highly with the sentiment, with that soft sentiment that you're trying to measure to. One example in digital is the big sentiment is don't bother me with marketing collateral. And so how do I constrain against that? Well, I measure who, and a lot of people will say that, but a lot of people won't actually do anything about it. So if they just say it and I just did it marketing, I'm going to leave a bunch of marketing opportunity on the table. If they actually take action on it, now I can build a predictive model that says people like this are very likely to opt out of marketing campaigns. So let's be very sensitive to those people. Let's build a constraint in our optimization framework that says, we're not going to exceed a 1% opt-out rate. Otherwise, that digital channel is going to be gone before we know it. So those are the ways that I think about sentiment, and how do I apply some quantitative method to something that's so qualitative. Because quite honestly, a lot of the survey data you get, and we all know, especially those that are involved in analytics, is typically biased. And even if you set up the best survey in the world, it's still going to produce some kind of bias in its results. So I think about it a little more tactically, where why does this marketing partner, or why does this advocacy group care about this sentiment, and how do I turn that into something that I can actually measure? That's really something that's very pressing in the digital space. Yeah. So we have a couple different levels of control group strategy. We're actually starting a new one relevant to that decision governance comment that I made around this new OCC Fed guidance that we received recently. But initially, when we did our first in-market test, we did good old-fashioned champion challenger, PMU methodology versus this optimization approach. Our modeling folks, the guys who build and gals who build my predictive models that I consume in my optimization, they have their own random sampling, where they're randomly assigning offers, randomly targeting people, so that they can build and calibrate their models over time. And then there's another piece that we're starting to get into as we start to do more of this contact policy, and what's the right offer, what's the right order, where we're going to start focusing on that contact dimension that I think is very critical, but hard to manage. Those are kind of 3 examples. And then we have some fold-out. In other spaces, we'll have fold-out samples where we don't do any marketing activity. And we'll measure the incremental value of doing nothing versus doing something.
Are you connected to product development? So that ultimately you can kind of get ahead of this?
Indirectly, not directly. Yeah, that's a good question. Product development is, we're going through some organizations to kind of be this customer segment oriented company, and product development used to be its own centralized function, and now it's within these segments. So you have different product development people within each segment. So it's a little. I talk to them. I'll say that. Whether I drive what they're building, now I'm probably not that influential on that side. When I've done some stuff on the predictive modeling side, one of the things that I've always kind of voiced is you have this void of where there might be people not targeting, or there might be one competitor in this one kind of dimension, and they have basically a monopoly in that space. And so when you share that information with your product development folks, you say, hey, look, here's where we need a product. See this big void. There's a big space here where we can easily win market share without spending a lot of money. So we've had some conversations over 2 years, I'll say, but it's not as fluid as I would like to be.
Just a couple of technical questions about the size of these models. How many decision variables and constraints are in a typical size model?
So our card marketing problem is probably about it's probably about 250 decision variables. Constraints probably about tend to be nonlinear. And there's a lot of exploratory work being done on that front. And so you can do some things where you just take polynomial regression curves, create a nonlinear solver, and you end up creating these, the camel home, where you have concatenating, concatenating. There you go, right? What's the, but you could be violating some mathematical principles because you're selecting a local optimal time level.
Because it's like climbing a mountain.
Yeah, in the dark.
You're at a peak, and you think you're at the top, but you look up and there's another peak.
Yeah, yeah. So a guy who works for me, who's brilliant mathematician, he always uses the reference. It's like looking in the dark. Searching and searching, and then, oh, here's my point. And then, then I stumble over here. Oh, wait, sorry, over here. And so there's definitely some, as you know, there's some techniques to turn that nonlinear problem into a linear one. And piecewise approximation is one that we explored recently.
It's quadratic.
Yep. Okay.
Ron, first of all, thanks for an interesting presentation, particularly as an individual who I feel like I've gotten about 11,000 in that, 20 minutes, whatever. I think it's down to 10, so I think you're doing the right thing. Anyway, so my question is, you run this for a while now, and I know you got control groups, but how's the profit against the predicted profit?
So that's something.
The actual bottom line for the profits.
Yep. So that's a good question. A lot of, and to be very honest, the optimization, there's a big assumption that what you're putting into it is completely accurate. And the optimization itself kind of stops once it's done doing its math. Right? So what actually happens afterwards, has nothing to do necessarily with the optimization. It has everything to do with the inputs that you're using and the assumptions that are in those inputs. And we have a very rigorous process around validating predictive models. So that's actually regulated by the OCC and the Fed. So if we have models that are not validating, we have issues. So we're very proactively managing our profit models, our response models, our risk models. And do we see error in some of those models? Absolutely. And how do you mitigate against those errors? One way is using constraints, where you can hedge, where you have known error or volatility in the model. You can hedge against that error, be conservative, in your risk estimate. Typically, we're conservative in risk estimate. We learned a lot during the last economic cycle, where I would say we probably weren't as conservative as we needed to be, and there's a lot of focus as a result. But we're validating models constantly. There's a very rigorous validation process. Longer term, how much money are we making versus the BAU? Last time I looked at it, I would say that we have like a 20% run rate above the current, the historical BAU strategy from a profitability perspective. Sure.
The math and statistics people that you have, are they spending the lion's share of their time on the input side, like developing constraints, or they're working on the actual optimization models themselves?
So my group is responsible for the optimization piece. We have a little functionality where we're evaluating the stability of inputs, but mostly we're doing the mathematical formulation and the algorithms.
So that's actually internal to your...
Yep. Yes. Yep. And then I have a very close, depending on our organization, so some literally within our same family, and then some within our larger family, where we're using predictive models from our same collective group from in our optimization. Now we'll sit in on a lot of the model development from a predictive model perspective, and we'll work pretty closely when we know it's going to end up being in an optimization framework.